Jamie Dimon, the legendary CEO of JP Morgan Chase for well over 20 years now, essentially says that tomorrow you could see a massive short squeeze or a massive liquidation in equity markets. So let's talk about how hedge funds are positioning today for the CPI report, which comes out tomorrow. Let's get straight into it, guys. So JP Morgan, Jamie Dimon says too hot CPI would put stocks at risk of a 5% tumble, not over the course of a week or a couple of weeks. He's saying tomorrow stocks could fall 5%, or if inflation comes in 7.9% or below, that could see lifting the equity gauge by at least 2%, which I think it would be a lot higher than that, given the S&P 500 specifically, but even the NASDAQ are at 52-week lows after 9-10 months of consistent drops pretty much every single month in the stock market. You're sitting at a low. It's been almost a year. Now, given that, given what the Fed speakers have been saying about potentially slowing down the pace of rate increases, this CPI report heading into the midterm elections will be the biggest data point likely throughout the rest of this year. So, JP Morgan, Jamie Dimon, also came out recently and said that the S&P 500 could fall another 20% from here. For context, the NASDAQ is down 35%. The S&P 500 is down about 26% since the peak. So Jamie Dimon thinks the S&P could fall to about 50% down from the peak. That's a pretty big drop. Now, specifically what is said here in this article, it says, when Jamie Dimon talks, the market listens. As the longtime CEO of JP Morgan Chase, the largest bank by assets in the US, not only has Dimon successfully navigated the company through multiple recessions and made JP Morgan a best-in-breed bank stock, but he has always had a good pulse on the economy. With more than $3.8 trillion of assets, JP Morgan is exposed to every part of the economy, from consumers to small businesses to the largest corporations, and in almost every sector too. In an interview today on CNBC, Dimon said he expected the U.S. to enter a recession in 6 to 9 months. He also said that while he doesn't know the future, the S&P 500, which is fallen roughly 25% from its all-time highs earlier this year, could fall, quote, by another easy 20%. Let's take a look at why Dimon is concerned and what investors should know. It says high inflation and rates could drain the consumer. There are several reasons why Dimon is concerned, beginning with inflation. The Consumer Price Index, better known as CPI, which tracks the prices on a market basis of consumer goods and services, rose a jaw-dropping 9.1% in June on a year-over-year basis, and there is no clear evidence that inflation has peaked yet. The CPI ticked up 0.1% in August from July, and economists expect the CPI to tick up another 0.2% from August when September inflation data comes out Thursday morning. Prices for things like rent have remained stubbornly high. High inflation has forced the Fed to aggressively raise its overnight benchmark lending rate, including 3 consecutive 0.75 percentage point hikes at its last 3 meetings. Rising rates increase the cost of consumer debt, which is why mortgage rates have soared lately. Payments on student loans are also expected to resume for the first time in more than 2 years, another burden for consumers. Dimon does believe the economy is still relatively healthy right now, but rate hikes can take time to work their way through the economy, so the economy has not felt their full impact yet. Hopefully, though, they will also slow the growth of prices and bring them down. Stocks face their own concerns. If consumer demand dampens, companies are likely to feel the sting on their sales and profitability. Companies will also face a higher cost of debt and a higher cost of doing business. Many investors think analyst earnings projections are still too rosy. If third quarter earnings and guidance disappoint, expect downward revisions, which will potentially lead to lower valuations and lower stock prices. That's one big thing that I really want to highlight here, is there is still a lot of earnings risk, because we haven't even started third quarter earnings season yet, and we're just now about to start with this Friday. You have a lot of the banks that will be reporting earnings. Now, let me teach you guys something that basically everyone else in the AMC and the trading community is not really going to talk to you about, and that's what is really going on, what real investors care about, what hedge funds, money managers, how they're going to position their money based off of the CPI report tomorrow, and why you could see a 5% drop in the markets or 5% rally in the markets tomorrow, in my personal opinion. Essentially a short squeeze or a crash. It comes really down to fundamental valuations. But more importantly than that, when the Fed gets high CPI reports, when inflation is stubbornly high and persistent, that means the Fed has to raise rates. And then the world looks at the US economy and looks at the Fed and the dollar and bonds, and they say, hey, you can invest in a 10-year bond in America, the safest, most well-developed country in the world, and get a 4% yield every year for the next 10 years. Doesn't look too bad if inflation will eventually come down. And you also look at the currency, the US dollar, which is strengthening, and that is making people think to the British pound, which is hopefully relevant in everyone's mind. That is devaluing relative to the dollar. So the pound's going down in value and the dollar is strengthening relative to almost every currency around the world. So how that affects fundamental valuations is, say, Apple, that's selling iPhones across the world, essentially in every single country. They take in foreign currencies. People in China, Japan, they're not buying iPhones in US dollars. They're buying iPhones in wons and yens. Those currencies, are weakening compared to the dollar. Apple's, for an example here, it's happening to a lot of basically every worldwide company, taking in those foreign currencies, converting that into US dollars. And as an investor in those companies, you might still say, hey, Apple sold the same amount of iPhones for a higher price, but the currency devalued. So when they take that $1 billion and put it from wons, for an example, into US dollars, it's going to be a lot less, meaning fundamental valuations have to come down for these companies. And all of that depends on the CPI, depends on the course of inflation. If inflation comes down, investors will say, hey, maybe we should buy up foreign currencies, because the dollar, maybe the dollar is probably going to weaken because the Fed's not going to have to raise rates as much, again, because CPI is coming down. On the opposite effect of that, if inflation continues to go higher and is stubbornly high, even though the Fed continues to raise rates, people are going to say, hey, the bonds have to go up in yield, so hey, we're going to sell off our bonds, we're going to buy them back for a higher yield. And essentially, long story short, what that is going to do for the economy is bring up interest rates, bring down fundamental valuation. So that's why CPI, especially as we are, 10 months into high inflation and a crashing stock market, that's why this CPI report that comes out tomorrow will be so very important and essentially cause a short squeeze to the upside, or potentially a major crash to the downside. All right, guys, now that the backstory of why this is so important, why we could see a 5% drop or a 5% rally tomorrow is out of the way, let's talk about how hedge funds have been really positioning today for the CPI, which comes out tomorrow. And we're looking at the S&P 500, the NASDAQ, the Dow, everything's going to look similar to this because they're all kind of positioning in the same way. And as far as the option activity, we were actually net positive today. You've seen 5,994 orders totaling $1.6 billion that were placed today on the S&P 500 with a positive order value of $54 54%. Now, some of these strategies they use get complicated. That's why you want to look at the positive order value, because it's saying for $1.6 billion, over half of that, 54% of that dollar amount, was skewed to a positive move, hopefully coming tomorrow in the stock market. And even better yet, yesterday you did see more orders, 6,872 orders, totaling a lesser amount, $811 million, only about half of the dollar amount that we seen today, but the positive order value was 70%. So that's looking pretty good as of right now. But if you look at the actual option chain, specifically that expires on Friday, the total open interest sits at 32.33% for the call side, and the open interest for the put side sits at 67.67%. So this is where you could get a really big reaction to the upside, in my personal opinion, is because so many options that expire this Friday are skewed to the downside. If that downside move does not happen, you're going to see a lot of people that rush to get out of those options, and you're going to see the calls really appreciate in a very aggressive nature coming tomorrow, coming very early in the pre-market, 8:30 in the morning. You're going to see a couple percentage point move on the S&P 500 as well as the NASDAQ based off of the CPI report. Now let's also take a look at the short interest. So the live short interest as of right now has the short interest sitting at about 17.85%. This is down quite a bit from the last time we looked at this, where it was over 19%. So that does look to be a pretty good thing overall. Now you do have a cost to borrow average at 1.1% and a cost to borrow max at 6.91%. That is also indicative of saying the markets are going to have a very big move tomorrow, because cost to borrow max does not usually go above 3% on the S&P 500. That is very unusual overall to see a cost to borrow max that is that high. And as of September 29th, that was the last trading signal we got for the S&P 500. It did indicate a buy, which that did not look to be correct. Over the subsequent 2 days, you did go up about 2.5%, but we have definitely sold off a lot since then, and you're sitting at the lows of 2022. So I think potentially a lot of the negativity or a slight miss on CPI, meaning CPI comes in a little bit higher than expectations, might somewhat already be priced into the markets. And unless we get a big miss on CPI, unless CPI comes in at like 8.5%, I don't think personally you're going to see a 5% down move, maybe a 1-2% down move, typical of what we've seen in 2022. That could definitely happen. But I think a slight beat even to CPI, say CPI does come in at 8% or 7.9%, you could get a very big move to the upside. So let me know what you think in your personal opinion, what's going to happen tomorrow with CPI, how the markets are going to react. Thank you guys for watching. Hit the like button, subscribe to the channel, do what you guys want to do in that regard. Appreciate you guys very much. I will see you in the next one.